All right, everybody, this is part 3 of this 3-day series that I'm putting up here on creating your own gold standard, how to live on a gold standard yourself. Even though the system doesn't operate that way, you still can, and it is a far better way to view the world of finances through in terms of saving, in terms of money, in terms of debt, in terms of investing, and it is far more profitable to approach your lifestyle in this way because it lets you engage in the fundamental laws of money instead of viewing everything with the veil of fiat currency blocking your view of how things actually work. Today, it is part 3, and we are talking about how to invest and how to view investing in terms of a hard money system and living on a gold standard yourself. Let's dive in. If you have not already, you do need to go back and watch part 1 and part 2 of this series because it provides some background into the way that hard money systems work, the incentives they provide, when to borrow money, when to not borrow money, and how to look at that through the lens of living on a gold standard yourself. Today we're discussing investing and how investing looks very different through a gold standard than it does through a fiat standard. In a system where the money declines in its purchasing power over time, you have distorted barrier of entry in terms of what you need for a return on your money. If you put your money in a CD and you get a 1% return, you think that's great. But when you realize that inflation is probably between 5 and 10%, depending on the city that you live in, you're actually losing a lot of your purchasing power every single year. And further than that, when you invest in stocks that produce an annual rate of return of 4, 5, 6, 7%, you could still be destroying your wealth and losing real purchasing power over time when you realize that once you sell that investment, you can actually only purchase a fraction of what you could with that same money that you used to invest. And so when we're investing, we need to look through the lens of a hard money system. We need to look through the lens of something that doesn't change its value over time or slowly appreciates in its purchasing power over time. And when you do this, you come away with a startling conclusion. Appreciation and long-term capital gains are largely a mirage. And for the most part, they don't really exist. I'm going to throw a chart up here of a 120-year timeline of the Dow. But instead of pricing it in terms of dollars, this prices it in terms of ounces of gold. How many ounces of gold you would need to buy the Dow. And you can see here that historically, it always comes back down to 1 ounce of gold. That there are brief periods of time where there are large bubbles blown up in the valuation of companies that are included in the Dow, and then eventually it reverts to the mean and you can buy the Dow again for 1 ounce of gold. Now, this should blow your mind, and if it's not, you might not be comprehending what you're looking at here. This means that when you look at a 100-year chart of the Dow in terms of dollars and it goes up and to the right, what you're really looking at is a devaluation of the currency. All you're seeing there in terms of that long-term growth, the majority of that is actually just the purchasing power of the dollar going away. It costs more dollars to buy the same investments, not because those investments have gained in value, but because the dollar's purchasing power has left the building. And so when you see financial experts say markets always come back and markets always go up, we're in it for the long-term appreciation, we don't care about the daily drawdowns. They're deceiving you. Long-term, there is no appreciation. Long-term, things revert to the mean. And if the only thing that you're banking on and you're investing in your retirement is appreciation, you're essentially gambling. Because with a blink of an eye, a company like Amazon can have its CEO, Jeff Bezos, die and the government attack the company and try and split it up into 5 different companies because they say it's a monopoly and take over one part. And before you know it, all of your gains that you were sitting on for 5, 10, 15 years are gone in the blink of an eye. And you did not gain 1 ounce of real return on that, especially when you compare it against the purchasing power of the money that you originally invested in. So if you can't count on capital appreciation to invest your money, what is the bar? What can you rely on? How should you invest your money? And surprise, surprise, ancient wisdom comes in again. That age-old wisdom, hundreds, thousands of years old advice that has stood the test of time comes into play again. Income. Cash flow. That's why multimillionaires and billionaires do not invest for appreciation. They invest for cash flow. They invest for income. Because income, whether it's dividends from stock, rent checks from real estate, income is the only way to ensure that you start to collect a real return on your investment. Now, I need to pause here because what some of you are hearing me say is that it's impossible to actually have your money appreciate in a stock. That's not what I'm saying. What I'm saying is that's not investing, that's gambling. Because the only thing that you're relying on to be able to make money is to sell your investment to somebody else at a larger price than what you paid for it. And that's not investing, that's gambling, that's speculation. And again, I'm not saying you can't make money with that. Lots of people have made lots of money by speculating, but it's very important to realize that that's not investing. And that's why some of the age-old advice, some of the thousands of year old advice about how to invest doesn't look at speculation as investing because it's not reliable, and you can't actually see that from a systemic point of view. You'll see that in some companies that kind of hit the lottery or do things right, but if it was possible to pick those companies out before they actually did that and avoid all the companies that were not going to have that massive growth, then you would never see something like an index fund exist. But the fact that index funds do exist and show total system returns, and the fact that the total system returns eventually revert to the mean, which is 1 ounce of gold for the Dow, means that as an individual investor, the only reliable way to make sure that you're actually getting a real return on your actual investments is investing for cash flow and income, not for appreciation. Now, this is key because when you put this into perspective of the last 2 videos that we talked about when to borrow cash in order to make an investment. And it's when the return or the value of whatever you're deploying your money into, it has a greater return than the value of the debt, the cash, losing its purchasing power. A very common example of this is real estate. If you take out debt and you borrow currency to buy a house to live in, yeah, eventually that house is going to be worth a lot more than the value of the debt that you use to buy it, but that's only a reflection of the value of the dollar losing value. So when you're making an investment, you're not going to rely on that. That's why a personal residence is not an investment, because you're only relying on being able to sell that house to somebody else at a greater price. And that's gambling, that's speculation. So when you take out cash to invest, you're going to invest that in, instead of a personal residence, you're going to invest that in something like a rental property, because a rental property provides cash flow, and that cash flow pays the debt. And then the bar of entry for you to make an investment is that the cash flow that you're receiving is greater than the cost of servicing the debt. And the bigger the margin, the safer that investment will be. And then at the end of the term of the debt, you'll be left with at least some value in the house and no debt left to pay, and you'll still be collecting income. So income is the only way to make sure that you can service the debt if you're going to be using debt to purchase an investment. And then you're going to be using that as your measurement, your bar for what do I use debt for. You're going to be looking at the cost of the debt and then the cash flow, the income you're receiving, and making sure that there's a margin, and the bigger the margin, the better. And you're not going to use debt for things that are speculation, because if the speculation turns out to be bad and let's say the stock that you bought on margin goes down, well, then you're out of luck. Now, investing in the United States stock market for cash flow today is actually pretty difficult, because over the last 30 years, the Wall Street and the American public has gotten very used to seeing this capital appreciation, which is truly just a reflection of how much purchasing power the dollar has lost. When you look at earnings and traditional valuation methods, the valuations do not match up. And so the majority of the growth that we see in the stock market has been to cutting the value of the money by printing more of it. And it's extremely hard to find any stocks that pay a decent dividend. But you can find great dividend paying companies in other markets around the world that have not been kind of brainwashed into the mirage of investing for capital appreciation only. Now, one way you can produce income on a U.S. stock portfolio is with options. If you own a stock portfolio, you can write covered calls against your stocks. And I have just a few days left on the sale for my options course. You can find that in the description below. Take my options course, buy that, and that'll catch you up to speed with what you need to know if you want to write covered calls successfully to produce some income on your stocks. Or even if you are using it as, to sell cash secured equity puts as entries into buying stocks at good prices, you can do that as well to make income on a stock portfolio. But in general, in the United States stock market, just with the stocks alone, it is difficult to have income and cash flow on a portfolio of stocks. So international stocks do this well. Real estate does this well. And it's very important to remember that you're not conflating investing with debt. When you buy a bond, the traditional financial advisor is going to say for the income portion of your portfolio, buy bonds because they'll pay you income. Number one, it's not an investment, it's debt. Number two, the income is never going to be more than the money you're deploying into it to begin with in terms of its purchasing power. So when you invest for cash flow. And when you loan money, don't loan fiat currency. Again, watch the last video on debt if you haven't already. So this concludes the 3-part series here that how to actually create a gold standard for yourself. Money is gold and nothing else, as JP Morgan said. He also said money is gold and everything else is credit, and that is true. Fiat currency is just credit. You're just relying on the good faith of the United States government to not do what it's always done, which is devalue currency. So if you're saving, save gold. If you're loaning, loan gold. If you're borrowing, borrow fiat currency. And if you're investing, invest for cash flow that provides a real return over the cost of the debt if you're using debt. And if you're not using debt, that just provides a real return, because then you immediately start to see a return and you're not relying on the greater fool theory to just hopefully someday you can sell that investment to somebody else. And you're also not going to be tricked by the appreciation in the asset in terms of dollars only. You're looking at everything through the baseline of what is gold doing. And pretty soon here, the Dow is going to come back down in terms of gold, and you'll be able to buy the Dow with 1 ounce of gold. So thank you so much for sticking with me through this 3-part series on how to live on your own gold standard. I hope you can see that viewing life this way, your financial life this way, gives you a lens to interpret things better, and it shows why some of this ancient wisdom actually still applies, as long as you realize that gold is money, and that some of that ancient advice, some of that age-old wisdom that your grandmother and your great-grandmother talked about, and some people like Dave Ramsey still talk about, it doesn't apply when you look at currency. It applies when you look at things through a hard money system. It applies when you look at gold. If you have any questions about what I've said in the last couple of videos, in this video about how to view life through a gold standard and create your own personal gold standard for yourself, please let me know in the comments below. And thank you so much for watching. You guys have a great day.